Now let's look at some of the key rules relating to the application of global minimum tax as under. So this is the subject to tax rule. Now, this is the simplest of the one, and you would have actually seen this in some of the treaties. We will discuss this shortly. There's an income inclusion rule, there's an under tax payment rule, and then there's a switchover rule. We're going to discuss each one of them in detail in the subsequent slides, but even before that, let's just briefly look at as to what each one of them means. Income inclusion rule. Under the income inclusion rule, what happens is that there is a top-up tax on the parent entity in respect of low taxed income of constituent entities within a multinational group. So if I just go back to the previous slide, I had actually told you that there was a UPE, there was a PICO, and there was a low taxed entity. So if the income of the low taxed entity suffered a 0% tax rate, this income will be included in the income of the ultimate parent entity, and the ultimate parent entity will be liable to pay a top-up tax of 15% on this income, assuming the rate of tax here in LTE is 0. Then there is an under-tax payment rule. Now, what this under-tax payment rule does is it protects jurisdictions against base erosion through intra-group payments or to low-taxed entity. In such a case, what happens is, let's say PICO were to make a royalty payment to the low-taxed entity, and for some reason, income inclusion rule is not applicable on UPE because the country where UPE is, they have not applied the income inclusion rule. In such a case, to avoid base erosion for the jurisdiction of country P, which is having a deductible royalty payment, there may be an under-tax payment rule whereby the extent to which the income is paid by PICO to LTE, they will have the right to collect taxes on them. Now, the next rule is the switchover rule. And in this case, what happens is, let's say a company has a permanent establishment in another state, and the income from this PE is exempt in the jurisdiction of the head office. If the rate of tax in the jurisdiction of the PE is lower than the global minimum tax, what this rules provide is that this company can actually switch over from exemption method, whereby the income of the PE is totally exempt, to a credit method. What that would do is, let's say if in this jurisdiction the tax rate was 20%, if the exemption method was followed, the total tax on the income of the PE would be 0. But if a credit method is followed, then the tax payable in this jurisdiction will be 20 minus the tax paid in the jurisdiction of the PE. And what this would do is, effectively, the overall tax calculated on this income will be 20%. Subject to tax rule, again, this is a simple one. This basically says that if a company makes over certain payments to another entity, and this income is not taxed in the hands of this particular entity in the jurisdiction, in such a case, the exemption or the lower tax rate provided by this entity on these payments will not be applicable. So let's say if there was a royalty payment which was made by X to E, on which the TDS rate was 10%, but there is a 0% tax rate here. In such a case, this 10% tax may not apply, and country X may choose to apply the tax rate applicable on corporate profits on its income to this particular payment. Thank you for watching our video on international tax. In case you want to subscribe to our full course, you can go to the link courses.sortingtax.com. If you are an Android user, you can download our application, and when you go to this link, you can purchase the course here. In case you are looking for a different currency of pricing, you can click on the link given in the description here and purchase the course. Thank you.